Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in my regular Wednesday episodes, I talk about the theory, methodologies and principles associated with investing. The aim of these case study episodes is to share how that approach really works out in real life. So the clients that I'd like to talk about today is really around how property investors should diversify. Property investors tend to be very focused on property. That's not all investors, of course, but people tend to be attracted to property as an investment option for a lot of different reasons. Firstly, it's very physical. You can kind of understand it. You might have had experiences with property, either yourself or your family, as in your parents have done well out of property. You've got a lot of control over property. And so these are some of the characteristics that attract people to property. Now, one of the downsides to thinking property is the be all and end all is that, you put all your eggs in one basket, which doesn't make a lot of sense. And so I started working with these clients I want to talk about today 10 years ago. And 10 years ago, they had just acquired 2 investment properties. So they had their own home, but they didn't have any other investment assets other than a little bit of super. And so they thought, yes, we need to borrow to invest in property. And they went and acquired 2 houses. And so back then, 10 years ago, the houses were worth $850,000, $900,000 each. They bought one inside super and borrowed about $420,000. So about 50% of the cost. And the one outside of super was much heavily geared, almost 100% geared. So they had made those decisions before coming to us to get some advice. And at the time, they had a direct share portfolio. They were dealing with a share broker, and they had a direct share portfolio in the super fund of about 160,000 and a little bit of other super in some other funds. But the main asset inside super, and at that stage, super was worth about 800,000. And so the main asset was the equity in the property, which is about 430. They had another 160 of shares, as I just said. And then they had a couple of hundred other $1,000 of either cash or some super in some other funds. And so the brief to us, which is pretty specific at the time, was, okay, we know we've got these 2 properties. We've got some money left over. We've got a handful of direct shares, only about 10 holdings in direct shares, all in the ASX 50, so all in the Australian market. We need to build some diversification. And thankfully, the self-managed super funds assets are now worth over $2 million, and that's despite drawing a pension over the last couple of years. So we've been taking $60,000 or $70,000 out per annum, but the property has only increased by about $300,000. So as I said, in 14, it was worth around about $850, and today it's maybe about 1.15. So it really hasn't done much over the period of time. The biggest contributor to their wealth, thing that's done all the heavy lifting, is the contributions into super, but also the investment returns over the last 10 years as well. And I think the big learning for me here 10 years later, from year to year, you don't tend to sort of necessarily sit back and go, okay, what has been the big movement in value? But it's not until you produce these case study episodes do I look back and go, wow, if they hadn't have made the decision to get some advice and to invest super wisely 10 years ago, they would be in a pretty ordinary situation today because the property really hasn't done much in terms of capital growth. However, now they've got about $3 million of investment assets to fund retirement. So they're going to have a very comfortable retirement. They're not going to need to worry about money at all. And so I thought it was a good case study because let's then think about what are the things they have done over the last 10 years or the decisions that they've made that have got them into the position where now they've got $3 million of net investment assets to fund retirement. As I said, more than enough money to not only do that, they've got 2 children. They'll probably want to help them get into the property market at some point, and they're going to be able to do that as well. And so let's have a think about then. There's really 4 things that I've reflected on that I think they've done really well. The first one is that they've managed cash flow really well. They've always been good at managing cash flow. They've never overspent or spent beyond their means, and they've been focused at putting money in offset accounts, both inside the super fund and also outside the super fund, to the point where they've reduced the debt by half outside of super. So about 400,000 they've repaid or offset over the last 10 years. So they've been very good at cash flow management and making sure that they're carving off that surplus every year to contribute towards their future. The next observation isn't a positive one. They've really messed up the asset selection with respect to the property. The property inside super is only appreciated at 2.5% over the last 10 years, which is half the rate of the median house price. And the property outside super has done a little better, 3.8% over the last 10 years, still below average. I do recall back in 2011 or 2012 recommending and referring them to a buyer's agent, and they kind of balked at the cost. They didn't want to use a buyer's agent. And unfortunately, they've ended up making some mistakes. Not terrible mistakes. The properties are okay and have some positive attributes, but the floor plan's just not right. The locality's just not right. And unfortunately, it's reflected in the returns. Now, Melbourne's underperformed over the last 10 years, so I'm not suggesting that if they'd have made a different decision, they would have got 10% compounding growth over the last 10 years, but they should have done better than 2.5% and 3.8%. So that was a big mistake to my mind, and it always is, particularly when investing in property. It's the actual property you buy. That decision you've got to live with for a very long time, and that's what's going to determine the long-term returns. Which leads me into my third point, which is diversification is important. Again, if they had not have diversified, and let's say Jay just said, well, we've got 2 properties now, one inside super, one outside super. Let's just focus on debt reduction and let's not do much else other than that. Or let's continue with the stockbroker and use a strategy that doesn't really have the evidence behind it that's going to produce the returns that we need in order to fund retirement. If they hadn't made either of those 2 decisions, they'd be in a much worse position today where retirement might be compromised. They might not be necessarily able to retire or have a comfortable retirement. So I think the combination, I always talk about us at Pro Solutions being what I would describe as asset class agnostic, in that we don't really care whether our clients invest in shares or property. We think that probably for most people, a combination of both those assets probably makes sense. But at the end of the day, we're not pushing a barrow towards any particular asset class. And this is a perfect reason for it, is that these clients, the property will probably eventually produce some good returns, especially as I expect Melbourne to have pretty strong returns over the next 10 years. And you would argue perhaps that property is intrinsically undervalued as well. So it's unfortunate time to do this review. So I think the property will work and certainly do much better than it has the previous 10 years. But it really does show that if they weren't in the position where they are today and they had the share market investments, then they would be far less comfortable about retirement than what they are today. And finally, evidence-based approach. Again, something I always bang on about, but they departed from an evidence-based approach with respect to their property acquisition, which I've just talked about. Asset selection or making a mistake around asset selection is very costly. But what they did do right is that they acknowledge, okay, we're not going to be able to manage these investments inside super. We need someone to do that on our behalf. We then employed an evidence-based approach, low-cost indexing, rules-based approach. We've still got some direct Australian shares that they held 10 years ago, like CBA, for example, just because it's performing so well. But we've introduced a lot more diversification to the portfolios and a much more considered asset allocation, which means that we've got exposure to emerging markets and international markets and bonds and so forth. So we've got a much better portfolio that's working for them now, and we could still accommodate some of those existing investments that we thought were okay. So this case study is really a good news story, I guess, in terms of the clients are in a really good position. They've got a comfortable retirement. They don't need to worry about money. But, we can certainly learn from, some of their mistakes, I guess, that they made, particularly with property, and some of the successes in terms of good decisions they've made with respect to investing in other assets and not necessarily just relying on debt reduction. Okay, I hope that's useful and enjoyable, interesting to listen to. And until tomorrow, bye for now.